Let's talk about IFRS 9 and its implications for organisations outside the financial services sector. First, a quick recap on when IFRS 9 comes in. So its accounting periods beginning on or after 1 Jan 18, and this standard on financial instruments will replace IAS 39. Now, I think IFRS 9 majorly impactful as a standard for those organisations within the financial services sector, particularly banks, but there are some implications for non-financial services organisations to be aware of. And the three areas I'm going to look at in this short presentation is measurement, impairment, application of the expected loss model for trade receivables, and also a quick run through some of the new rules around hedge accounting. Let's begin then with measurement. In terms of receivables, I guess in the context of an ordinary trading company, you could have loan receivables, you could have trade receivables. They will ordinarily be accounted for at amortized cost. I mean, what IFRS 9 says is that when you're lending money and all you're looking to do over the loan term is collect out on the contractual payments to which you're entitled, and all you're going to do is charge interest linked to time value of money and credit risk, then that will be a simple, straightforward loan that you'll account for at amortized cost. And that's very much the case, I would imagine, for most trading companies. And indeed, if they're trade receivables, that will also be the case, and they'll be accounted for essentially at the face value of the invoices. One thing to look out for, which again, if you're familiar with UK GAAP in the form of IFRS 102, you will know all about, is non-market rate loans. If a trading company lends money, let's say, to a related company and charges a non-market rate of interest, let's say does it interest-free, what you're going to be required to do in that situation as the lender is discount future payments to it from the borrower back to net present value using a market rate, and that will then give you a day one carrying value for the loan, which is less than what you've actually lent. And what you'll then need to do over the loan term is gradually grow that debtor back up to the repayable amount with a corresponding credit through interest income in the P&L. And what you should also get then is a kind of a symmetrical approach in the books of the borrower. So these loans will still be basic, but that will be the feature. And as I say, if you are familiar with the issue of non-market rate loans on UK GAAP, you'll be very familiar with the idea here. It reflects in the same way in IFRS 9 also. Thinking more generally about the measurement of financial assets, under the old IAS 39 rules, we had a plethora of different categories of financial asset. We had financial assets which were available for sale, held for trading, held to maturity, and each seemed to attract its own different accounting treatment. Under the IFRS 9 rules, it becomes much more simplified. The one I think probably you'll see many ordinary trading companies having will essentially be equity investments. And as the slide indicates there, with equity investments, it's fair value through P&L, unless you choose an irrevocable election on day one to account for that investment at fair value through other comprehensive income. Now, I think under the old IAS 39 rules, investments would invariably of this type get accounted for at fair value through P&L. There was a specific exception, though, whereby if you had investments in shares in a private company and you could not determine fair value at the outset, you would be allowed to use cost. Now, that's no longer allowed. You would be having to use fair value for all investments in shares. You may, of course, assume, potentially, that cost might equate to fair value. But unless that's the case, a fair value calculation would be needed, and that could give you a different approach under IFRS 9 to what you would have had under IAS 39. Very important scope out, though, from that point I just made, is that investments in shares and subsidiaries and associates and joint ventures are totally scoped out of IFRS 9, and they can always be accounted for at cost should the preparer of the accounts so desire. On to impairment. You may be aware that under IFRS 9 there's a new sort of model really to reflect impairment of loan receivables. Very much an issue, I think, for banks. It's referred to as the three-bucket approach. In essence, what it does is moves us away from the current incurred loss approach and pushes on to what we call an expected loss approach. And what it really is doing is allowing the actual lender or allowing the seller to look forward and anticipate bad news around the corner, rather than always requiring a pre-year-end trigger event to drive the need for a impairment adjustment to be made. This, I think, dates back to the credit crisis in 2008, when the incurred loss approach under IAS 39 was required, and you would always need in those days, as we do pre-IFRS 9 generally, to look for a pre-year-end trigger event to drive the need for a provision in the year-end balance sheet. That many felt meant there was a big store-up of bad news. Then the crisis hit and many bank balance sheets imploded, which is why under the new IFRS 9 rules, we're taking a more pragmatic approach. As the slide indicates, it's slightly moving back more towards a prudence-based approach, but with appropriate checks and balances in place. Now, major issue in the financial services sector for banks, less impactful for trading companies, but as the slide indicates there, you will for trading companies also now recognise lifetime expected credit losses without the need for a pre-year-end trigger event to drive that provision being booked. If information is brought to bear in the post-year-end period, you will use that to inform provision in the year-end balance sheet. So what I always think about a situation where maybe if you are as a company selling to company A, and perhaps in company A's marketplace, there's some financial distress and all companies in that sector have had some sort of credit rating downgrade, you might use that to drive a provision for impairment in the books of the company vis-a-vis company A, where under the IAS 39 rules, if company A were in terms at the year end and there was no indication at the year end of problems around the corner, you would not be allowed to provide. The old rules very much not oriented towards prudence. The new rules more so, but as I say, with appropriate checks and balances in place at the same time. Last area here, hedge accounting. Let me just remind you of the fundamental of the way it works. So under IFRS, for many a long year, where an entity uses derivative instruments, for example, to hedge, against risk, the ones I always think about are things like forward currency contracts and interest rate swaps. You're required to account for those at fair value on the balance sheet. If, to take the example of a forward currency contract, though, you're using that forward currency contract to mitigate exchange rate risk on a transaction that as of the year end hasn't happened because you've not bought or sold the related goods yet, what you're allowed to do is take the revaluation gain to reserves in the short term and then release it back to profit and loss later when the related transaction takes place. Now, under IAS 39, to do that, required to jump through quite a few hoops. And what IFRS 9 is doing is really introducing a more pragmatic approach to make hedge accounting more simple and straightforward. So hedge accounting, as we described it, will work more in alignment with internal risk management strategies and objectives. And you'll be able to do it in respect of more types of hedging relationship, where IAS 39 would have probably not let you. The other point which I always recall from 39 was you had to work very, very hard to demonstrate hedge effectiveness in order to actually use the accounting treatment I referred to. And they talked about, didn't they, in IAS 39, the 80 to 125% test. If you didn't meet that test, you couldn't do hedge accounting. That's gone away. What we're now doing is take a more pragmatic approach, linked as it says to where you are genuinely in the business using it as a risk management strategy, then you can, in that context, hedge account in the way we've described. One specific point of detail in terms of, again, a change in IFRS 9, IAS 39 always talked about embedded derivatives and said if there was an embedded derivative within a host contract, you need to unpick that and account for that separately on your balance sheet at fair value. So, for example, if we had a loan, an ordinary loan contract, where the loan interest was linked to, let's say, some sort of commodity price index, you've got a derivative instrument embedded in that host contract, you'd unpick it and fair value it and account for the two really as separate instruments. That's gone away under IFRS 9, less imperative to unpick embedded derivatives, and in that way, again, it does make the accounting treatment significantly easier. So there you go, there's a few headlines there, I guess, in terms of IFRS 9. Just a couple of final points to remind you. First of all, this comes in accounting periods beginning 1 Jan 18. You may, if you change accounting policies in this area, need to make adjustments, therefore, at day one of your comparative period, 1 Jan 17, and roll it all forward from there to make comparatives consistent. You may need to think about accounting policy changes. And don't forget as well that what IFRS is very keen on is disclosure in the notes of the accounts of key sources of judgment and estimation uncertainty. And if those sort of judgments and sources of estimation and uncertainty are linked to changes here, disclosure also will be required in that part of the notes of the accounts. So don't forget that one as well as you apply the IFRS for the first time.